friends and associates. Welcome to Wealth Builders in Denver, Colorado. Scripture says in Deuteronomy 8:18, "Remember the Lord, your God, for it is He who gives you the ability to produce wealth." As men and women of God, we all want to succeed in our sphere of influence. We all want to make a difference in the kingdom of God. We all want to leave a lasting legacy for generations. Are you ready to be challenged? Do you thrive on inspiration? We all need a healthy dose of encouragement. You'll also receive expert instruction on proven and practical strategies and documented best practices. That's what Wealth Builders is all about. It's time to get off the sidelines and get in the game.
We appreciate you joining us this morning on the live stream. And today we're going to be sharing a lot of things with you, but we call this Wealth Builders Live. And we come to you every Saturday morning at 10 a.m. Mountain Standard Time. And then also, we also answer your questions again on Wednesdays at 1 p.m. Mountain Standard Time. And so if you have questions on real estate, stock market, business, whatever, we're taking those questions at that time. And so, honey, we've got a lot of exciting things that are happening.
We do.
And we want to say how much we appreciate it. We have had a phenomenal response to those of you really across America, as well as in other countries that I think all 6 continents at some point are kind of a part of this Wealth Builders Live. So we want you to know we really appreciate it. And so today we've got a lot of things to share with them in the beginning.
We do. First off, we want to welcome you, all those that are tuning in. And we wanted to say that if you'd like more information or like some more articles or teaching, you can go to our wealthbuilders.org, and that will give you up-to-date events, access to our blogs, and much, much more. And so anyway, and if you'd like to subscribe today on the Wealth Builders site, now this is real exciting. We are going to be giving away Mike Davis's Beginning Real Estate. If you're just starting out, this is a great article, a great thing for you to have. And it's the teaching he did at our Wealth Builders 2020 conference, and he did an outstanding job.
Wow.
So he must have really put everything he had in it, but it was really good. So I encourage you to go on, subscribe, especially if you're first time real estate investors. You would love to have this in your portfolio. Also, you can purchase the full video and audio of the conference, and this is really worth the bucks, because it includes all of our speakers, their PowerPoints, and the full video and audio of that. So you can go on our website and get that. If you'd like some of the previous live streams, you're just now tuning in and thinking, wow, I've missed a lot. You can go onto the Wealth Builders site and you can click on and get all of the back live streams that we've done.
That's awesome.
I know. Catch up. Also, this is also real exciting. Our real estate workshop is June the 12th through the 14th. We have sold out, but we have opened it up for a live stream for $3.99. And that is going to include all of our speakers. Bill Broncheck will be on there, Dan Dyer, Karen Conrad, Mike Davis, and moi.
And I'll be there.
And you'll be there.
Wow.
And I'll make sure he's all ready to go. So anyway, also, we'd like to say congratulations to Christopher. He won the Money Mastery book last week. We will be putting that in the mail to you, Christopher, so be looking forward to that. And today, if you'd like to, our giveaway today is the Change Mastery book. And I would recommend that for anybody that it's alive and living, because we are all going through change right now. I tell you what, I need to reread it because I do need it. But you can go to wealthbuilders.org and you can subscribe, and your name will go automatically into the drawing. If you're already subscribed, your name also goes into the drawing. So everybody's got a chance at this one.
Now we know this is live because we forgot to hold up the Change Mastery book.
We did. It's right behind us. But
it's right behind us up on the shelf up there. And but we'll take a minute here in a few minutes, and maybe we can do that.
Yeah, maybe we can get it and get a copy of it, and then we can show you. Also, if you'd like to interact live, you can go down into the chat and type in your question, or you can go to the comment section on Facebook for those that are coming by Facebook.
Yes.
So everybody can comment. Do that. We try to answer questions at the end, but we can't get to all of them. So this is why Bill does the Wednesday
1 p.m.
The 1 p.m. He tries to get to all the rest of them. And those we don't get to, we will answer your questions. We will respond to you. Also, well, the last thing, if you'd like to give, you can go to wealthbuilders.org/donate. We think a lot of you have been giving, and it has really been a blessing because we're sending out a lot of books and tapes and things like that. Everybody's home, so people are asking for more. So we're sending out more. So thank you for your donations. And that's it.
And this morning we have with us on here some of our coaches, both business coaches as well as real estate coaches. We have Miss Karen, I call her Conrad, but Metcalf.
Yes.
Karen Conrad Metcalf.
Good morning.
With us from Dallas. And we also have Mike Davis, one of our real estate coaches in Pueblo, Colorado. Hey, Mike.
Good morning. Glad to be here.
And today we don't have one of the coaches that's always here, Dan Dyer. But we're going to, so remember, you can go to the chat on the Zoom and put your questions in, or you can do in the comment section of Facebook Live. You're able to do it there as well. So make sure you ask your questions today. And as you know, if you've been watching these live streams, you know we get to quite a few of your questions even during the live stream itself, and then we follow up. In fact, many of you have actually been, of those who've been participating, you've actually been even sending those in on Facebook during the week before the Wednesday, so keep doing that because we'll do our best to get to those as well. So today, what I'm going to do, those of you that are brand new, maybe this is your first one, we usually go through, we have up to this point, we've reviewed some different graphs that we look at about where the stock market, the economy, and real estate is. And so today we're going to start with the first two slides. On March the 20th, 2020, we were showing you where the stock market was. This is, of course, again, this is the S&P 500. This is an ETF called SPY. ETF means Exchange Traded Fund. And it tracks the S&P 500, an index of 500 stocks. And you can see on March the 20th how quick the market went down. And you can actually see that, of course. And then, remember, the bottom was March the 23rd. So this March the 20th graph, right, and by the way, we did this live with you back on March the 20th. Then on March the 27th, you can see this next graph where the market bottomed and then it popped back up, of course. And the reason we include March the 27th is because we're showing you where it actually popped back up or where it began to come back up. But and now the March the 30th graph gives us a lot more information. I mentioned to you, May the 30th. I said March the 30th. May the 30th, you can see the red line that's there. That red line is the 50-day moving average of the stock market. The black line is the 200-day moving average. And so that means what it's averaged over the last 200 days, for example. And I mentioned to you in last week's live stream that if you notice that the market had not broken above the 200-day moving average. And that's kind of where the resistance was. This week, it broke above this past week. We're talking to you on May the 30th, 2020, that it actually broke past the black line just a little bit. And we're getting ready to know if the market's going to keep going up or is it going to go down. So one of the questions that I get, and we're getting on here live as well as we get during the week, the question is, will the stock market go down? And a lot of people want to know because when we first came on here, we talked about the different kinds of recoveries. And we talked about, of course, the V-shaped recovery, which there's a whole group of people that believe we're in the V-shaped recovery. And then there's what we call the U-shaped recovery. Back then, we said we thought we would be in an extended U. Based on what we're seeing right now, I'll tell you where I think we are. But I believe that we're going to actually be in what I call a W recovery, which means that the market Now, this is my opinion.
Mm-hmm.
Will the market go back down? And so my opinion is that it will go back down. And I'm going to give you 3 reasons why I believe that's true. The first one is the stimulus packages that we have that have come out from the government, and really they haven't had a lot of choice here, both in the Fed as well as the government, the Federal Reserve as well as the government. That stimulus packages they can only last so long. They only have an effect for a certain amount of time. And so just to be real practical, we had the $1,200, for example, that came to individuals. We also had the PPP loan program that came for businesses. But whether or not that the U.S. can continue to do that, that's something to be seen. And so this next chart, I've actually shown this chart, this graph, the 3rd time where the Fed, you see the Fed stimulus in the market, and you can see that red line is actually the stimulus money, and how much stimulus money and how quick the stimulus money actually came into the economy. And now you see how the market has followed that stimulus money. So if the stimulus money does slow down, there's 2 things that are really, in my opinion, driving the market right now going up. The first one, of course, we've already said, is the stimulus money.
Mm-hmm.
The other 2 are there's 7 stocks. We call them the Feynman stocks. That's Facebook and Apple and Netflix and Google. So you just go through them, Microsoft. They're actually driving the market because those stocks have done, Amazon, those stocks have done really well because we're at home during the coronavirus.
Mm-hmm.
And so because of that people being at home have, for example, restaurants have just been totally hammered. The travel industry has been totally just decimated. But these stocks have done really well. And first of all, these stocks all have really strong balance sheets. They all look good, but they've also prospered real well during this particular pandemic. So they're really, and really they represent a large amount of the value of the S&P. So these stocks have actually been pulling it up. But then the last reason is because I believe there's a lot of people that are actually buying in the market right now that may not know better. They're just watching it and buying, kind of pushing it up. So I say that because I want you to see how it's responded to the stimulus. Then the second reason, if you can go to slide 7, Derek, the unemployment for many will last longer than expected. So one of the things that I've been keeping up with is the unemployment that's happened during this particular pandemic. So we showed you this slide in the last 2 live streams, but I'm going to show you something else about it here in just a second. So if you'll put that next slide up, Derek, which is slide 8, we showed you the red last week, and then we showed you a couple of weeks before. This is the 2020 employment for recession. And these other colored lines that are on this graph, including the blue one there, that big one that you see, the 2007, when we had the Great Recession, you can see how drastic and how dramatic the unemployment has been. Well, I've been reading some basic numbers, and I want to show you something I haven't shown you yet on this graph.
One of the things that I have come across or have heard, I've talked with some small business owners from just people that I know, and I think some of the backlash is that some of their employees don't want to come back because they're receiving more
money
on unemployment than they were when they were working. And the small business owners are saying now we're having to take a double hit because our unemployment insurance is going up, but the workers aren't coming back.
Yeah, and the workers, because they can stay home instead of making, $15 an hour. Some of them make $20 an hour with unemployment. But here's the kicker. If you notice the bottom of the blue line, the 2007 employment recession, if you notice where it was at its lowest point right there, if you trace it across, it's 6%. That means basically that 6% of the population is unemployed. Okay. Now you can see if you go down here on the red line, we're down to 14. We're higher than that. Today we're at about 18, 19% unemployment. Well, what what many are saying now, because of the small businesses in the travel industry and in the restaurant industry, many of that are having to go out of business, that even when the pandemic ends, that the unemployment is going to be in that 6 or 7% range, where we just showed you on that chart. So the reason, and I know a lot of people say, well, Billy, just tell me how to make money, quit talking about all that. But the truth of the matter is that it gives you the context in which you should or shouldn't be investing and understanding what the environment may or may not be. And in a second, I'm going to talk about real estate in just a minute, but I wanted to see this so that we're giving you 3 reasons. The first one was that I think the stock market will go down. The stimulus package only lasts so long. And then the next one is unemployment for many may last longer. And then here, I think for me, this is the big one, because I'm only 39, but I've lived long enough to actually see some of these things. And I actually lost a little bit of money during the 2000 tech bubble when all the tech stocks crashed. And I remember I bought a stock called Exodus Communication, which was one of the darling stocks back then. And I remember it's the first time I've ever seen a stock go to zero. And that stock, literally, the company closed down. It was no more. And I bought in at $125 a share. So
that's what you call bought experience.
That's what you call bought experience, because
now you're patient.
So I'm a little more aware. So this next one, which is slide 9, is really important. I'm just trying to give you some context, is that the stock market is currently trading at 25 times earnings. And I went ahead and put it on this slide. The historical measure is 15 times earnings. Now, so we're a large percent, right? About 60% or so above what the normal healthy market would trade at. Now, there are reasons that people will tell you that's fine and don't worry about it. And I'm not telling you to worry about it. I'm just making you aware of it. That right now the market is pricing in 25 times earnings. And I just want you to know that's rich. Historically, that doesn't last. So when we look at that, now, the last one I'm going to give you is on the next slide. And this slide actually, and if you count, I just want to point out to you on the slide in the column that actually says, I'll have to lean up. It says, did the S&P ever make a new low? Right there, that column. I want you to see that this was after it had gone we're looking at what we call a bear market bounce. And the stock market reached the low, then it came back up at least 20%, and then did it go back down. And so what I have on here is there's 25 different times that we've been in a recession when the market made the new low, as it were. And then after that, did it make a new low when it started coming back up, or did it go back down again? So if you look at these checks and X's on here, there's actually 25 of them. 10 of them are the red X's, and 15 of them are the green checks. Mm-hmm. The green checks mean that the stock market did make a new low after it had hit its original lows. And there's 15 green checks on there, and there's 10 red X's. And the dates are over here to the left, and you can kind of look at that slide and get some of that information. But 60% made new lows, and 40% it didn't go back down again. Now, so what that tells you is it may not go back down, because you have a 40% probability that it won't if you just look at historical averages. But then if you look at what has happened historically, 60% of the time it did. So people always say, what does that mean, Billy? Well, what that means, because I know some of you are watching for the very first time. Well, what that means is that you must understand and know, for example, that it can go down. But for some of you that are already invested in the market, even if it does go back down, just stay solid. It'll pop back up, as long as you have the horizon or the time horizon for it to do that. But for those of you who have not got in or haven't bought in the market, I would advise you to slow down and consider and watch what's going to happen before you just jump in blindly. Amen.
Amen. You don't want that bought experience.
I don't want that bought experience. There you go. Now, real estate. Let's do real estate. These are brand new graphs for real estate. And this is slide number 12. And we're looking at the housing market index here. What's real estate going to do? And so if you look at that, let me change this right here for a second. There we go. And if you look at this one, and I want you to see on here, this is the National Association of Home Builders. Now, I haven't shown this before, so I wanted to bring it up to you. And this is the housing market index rates, the relative level of current and future single family home sales. A reading above 50 indicates a favorable outlook on home sales, and below 50 indicates a negative outlook. So for home sales right now, the current level, and this is primarily new homes that builders have, the current level is 37. And so when you look at that, you say, well, Billy, what does that mean? Well, it means that even the new homes, for example, right now are being impacted during this pandemic. And of course, it could be that because of the pandemic restrictions, people can't get out and, go in and look at model homes or look at different places. But I just want you to see what's happening. The reason that I'm using this particular graph is you see the gray bars on the graph. These are just the most recent, if you follow this, pointing out at least 3 different recessionary periods. And the more wide of the gray bars actually represents that 07, 08, 09. And you can see how far that it came down there during that period of time. And you can see where it is now. So the real question is, how long would this last? So when we talk about an economic recovery, if you're looking at this graph, one of the things that I would say to you is that you can see that really it took about 3 or 4 years across there, 2 to 3 years across there for it actually to start coming back up. And that's more of what we would call a really extended U recovery. Okay, that's what we would call right there a real extended U recovery. So you see that, and then this is just an interesting one, and and I love the Fred here graphs, and so this is the next one, slide 13, Derek. And you can just see here, this is the monthly of supply of houses in the U.S. So you can see, and then of course it's got the gray bars for recessions on there. But you can see how right now the housing supply is actually lower. Now you can see where it popped up, kind of right, see where it's popped, and then it popped up right to the very right of the graph. And you can see the high little peak there, but then you can see it popping back up. But what's happening right now is that our supply, of course, people basically aren't listing their homes. And so supply is down. Where it's really going to matter is when supply starts coming back up. I always remember we teach that in the real estate course about housing supply and how you look at it and how you check it out to see if we're overextended. So right now, I haven't showed this graph before. This is a brand new one, and so was the one previous. But this shows you that the housing supply is down. And then the last graph, again, is from the National Home Builders Association. It's slide 14, and it shows new housing units started in the United States. And you can see to the far right, you can see where that has dropped. And so both on the single family starts and the total starts, you can see, of course, how the home builders have dropped. Well, what that's going to mean is that in reality, where we are is we're going to have to watch this to see how far in real estate that it comes back. So what I've been telling you in every one of these live streams, we've been talking about the fact that it's real important to know that in probably mid to late fall is when we're really going to find out kind of where real estate itself is going to kind of settle in. So my wife is looking at me like I've been talking too long about too many graphs. So I'm just trying to give you a context. And when we start answering questions here in just a moment, we'll try to apply this information so that you're able to understand and know how to use it in your own life.
Well, I know a lot of people right now, aren't they? So you're suggesting they hold off to fall before they purchase? I know our neighbors sold their home and they're not buying right now, they're renting.
Yeah, they're renting.
They decided to go ahead and rent before they rebought again.
Yeah, and I
do you
think,
a lot of people
I'm
are gonna
saying
do that?
and I'm talking primarily to investors, real estate investors that are looking. And I always remember, no matter where I say no matter, take it into consideration where economic conditions are, but still the numbers are the numbers, meaning how you value or evaluate an investment for yourself will determine, you look at the merit of the individual investment itself, then you see how it fits your particular financial situation, and then you take it within the context, because remember the cycles, and we've given you several graphs here on the live on the real estate cycles. And so, so you understand how to play that. But if you're making a good buy at the time you make it, and there's enough cash flow coming in, that price to earnings ratio that we talk about also applies to real estate. And it does it in the area of rent. How much will your rent be? So as long as you're solid on that, when you're buying investment property, then you'll be fine.
Well, I have a house for sale.
Yeah.
Should I sell it now or should I wait?
You have a house for sale. Should I sell it now? Well, here's the quick answer to that is to don't, if you're a seller, don't get too soft on your price. If you're a buyer, wait for sellers to soften up on their prices. So the people are they're shaking their heads, but that's the truth. And because I think in time it'll come back. Now, if you're really needing to sell, I have other graphs that are some of the other presentations we've done that shows that actually they're actually holding up, meaning the selling prices have actually held up. They haven't softened. So that's a big deal. So anyway, just to let you know that. So let's do some questions.
Thank you. I jumped in ahead of the questions.
Awesome. Thank you. Okay. So this first question is from Brent Dirksen, who you both know.
Yes.
Hey,
hello, Brent.
And Brent says, I've heard the real estate market is peaking in regards to demographics. When the baby boomers start decreasing in population and the families are smaller, there will be net less population needing less housing. What are your thoughts on this?
Well, I think that's a great question, Brent. And if any of the rest of you want to jump in, just jump in. But I think the cycle that in the long-term cycles of real estate, the actual population growth does matter when baby boomers cycle through. But what you have to realize, Brent, there's also echo boomers, and those are the children of the baby boom generation that was born. Those echo boomers right now are just coming into kind of their ability to really buy homes, and typically most of them are now buying their second, and in some probably limited cases, third homes. I believe that same echo boom generation, if the economy holds up, they'll also, many of them, be looking to actually buy second homes. So you have to remember that. Then the third response to that is that we always have out of the country investors, and I know that Brent is from Canada, and so there are a lot of Canadian investors that come in, especially to the vacation areas of the U.S., especially the warm areas, the warmer areas, the Gulf Coast, the Atlantic Coast, and for that matter, even on the California coast, down lower, so down further south. So they drive some of those markets as well. And then you also have foreign investors when the economy is good that go to other vacation type spots as well as home spots. So I don't really believe it's going to have a major effect or impact because echo boomers are having children. So the whole baby boom generation came through, but they all had kids. And so if you look at the statistics on it, it looks pretty good for echo boomers. And then their kids, our son and daughter-in-law have 4 boys.
Yes.
So I know that's not normal for everyone here that's participating, but they have 4 boys. So the echo boomers are going, and that's the children of the baby are going to have an effect on that.
Awesome. Thank you so much. Here's another question that is coming in from an investor. This is a question on chat. Are there other countries that you would suggest people start to purchase property in?
Well, that's a great question. Do either one of you want to take that? Anybody? No? Yes?
Well, I'm not familiar with international real estate, Billy. I think that's going to be you.
So I think on the international, there's actually some good opportunities. You know, in Africa right now, we actually are building some homes, but we're doing that more to help people. And we've also built, and we can show you pictures of ones right now, as of today, sitting here on May the 30th. We have, I think, now 5 brand new, what we would call middle class homes.
Yeah, they don't have a middle class.
Yeah.
So it's either the poor or the rich.
So, but there's a few middle class coming up. So, this is specifically in Uganda. Then we have a bunch of starter homes. So here's what I would say in places like, let's say the Caribbean islands, or let's say if you want to go overseas to Asia. What you always have to remember is you're also playing the currency value game. I'm going to give you 2 or 3 things here to think through. One is you're always playing the currency value game. So the dollar, the US dollar, is the standard anywhere in the world. So that's what all currencies are actually hedged against. So when you look at it, you have to take into consideration not just the liability issues, not just the tax issues, which are huge. So you say, what do you mean tax issue? Well, for example, if you were to sell a piece of property in another country, and let's say you made, just pick a round number, you made $100,000 off that property, and you wanted to bring it back to the U.S., that $100,000 back, then you have to look at the repatriation laws that happen in that country, and you could end up paying as much as 50% easily in repatriation. So you have to look at that. You also have to look at how title is held. And so in America, having clean titles to property and having an actual title to your property is just a standard boilerplate issue we have in some foreign countries. The most you can do, even in vacation properties, is do more of like a long-term leasehold. So you got to know that. And then the last piece of that is really liability. Is you want to look at both not only what your liability exposure would be, but how safe that a particular country would be to invest in, so that you know that you're going to get your money back. But places like Europe, for example, and some limited places in Asia, as long as you're understanding tax liability and repatriation piece, then and you understand that market, that's really important. And there's a lot of shows on TV where people are going overseas and buying property. Most of what I see is Caribbean islands in Europe. Some of the other, and most of the time in all of those countries, they have worked that I just mentioned, Caribbean islands and in Europe, they have worked to accommodate overseas investors. So the last part to answer that is, if you can find an up and coming area and you still use the rent ratios that we teach, and you can get good rents on a property when you're not there. Listen to me, everybody. Even if you don't rent the property, even if you say, I don't care, I'm not going to rent it, that's fine. But you can determine if it's overvalued or not by what it would rent for. And that's what you got to ask. So all of those that are watching me sometimes shaking their heads because they live in Boston and going, I can't even get, 0.5% rent. Then you have to add in depreciation. So once again, I'll tell you, you can go to wealthbuilders.org and look at the real estate calculator. It takes all of those things into consideration to give you an idea. And you can definitely do that with foreign properties as well.
That's great. And Billy, we've got a lot of viewers from Canada. We've got Judy that's on a lot. And then this question came in from Asada. I hope I pronounced that correctly. And they're asking, is there opportunity in Canada specifically too? What do you feel about Canada properties?
Well, I have a good friend that is a very active real estate investor in Canada. In fact, he used to do conferences. We used to do conferences together, and both of us would teach on real estate. And he's very successful. There are some nuances in Canada that you need to take in consideration on how on the tax issue, not so much liability issues, insurance and that kind of thing in Canada is pretty similar to the U.S. But on your tax issues and how that real estate and the earnings on real estate is taxed, you have to look at that and factor all those in. Now, with that said, when you start figuring total return, and we're going to do an investment mastery workshop. I'm not plugging it because I don't have the dates, I don't think yet, but we're going to do, and we're going to show you how you look at any asset and actually look at the value of it based on what kind of return and being able to value it in different ways. So for example, we'll probably start with gold, but when I go to, the reason I'm getting off on this, when we look at Canada, for example, you have to take in all the different pieces that would matter that would affect you directly, then look at the overall return once you've done that. And that tells you whether or not, so those that are watching me from Boston and Austin, you're going to have to figure in appreciation in order to calculate a total return. Then you've got to look at what your tax situation is. So my tax situation, when I buy a property in Austin, is a lot better than most other investors because I get to write the whole thing off. So my situation helps me a lot against my income. Whereas if you're a beginning investor, it may not help you as much. So you've got to take, even in Canada, you've got to know your laws in order to know whether or not something is a good return for you. But I think Canada, because of its economy, generally speaking, is a really good place to invest if you know what you're doing.
That's awesome. Thank you, Billy. That's so helpful. This is a question from Judy Langveld, and she said, Billy, would it be a good idea to buy land only?
Well, do one of y'all want to take that, or?
Well, I could just comment on what I'm seeing here, and then I'll toss it over to Mike for more comment. I think it depends on the price. Like, for example, we've been looking at real estate here in Texas, and there are some areas that it is really hot. And I think looking at what's happening, there's a lot of regeneration of the downtown area. It's kind of becoming sort of a hipster place. You can sense in a market what area is starting to gain that momentum. And in those situations, I think purchasing land where people are even leveling existing houses and starting to build on it could be a very, very good idea. However, making sure that that price is right. I think right now, too, a lot of people are a little panicked as to what's happening in this urban areas. And so they're looking to go out into a place with a little more space. And I think that could absolutely be an opportunity as well. Mike, what are you seeing in Pueblo?
I absolutely agree with you. I think all of those points are valid. And as one person said, the great thing about land is they're not making any more of it. So I always think that if you can get a good deal on land, I think you should pursue it. As far as Pueblo is concerned right now, it was really booming before all of this. There were houses popping up everywhere. And I got a good friend who's a contractor now, and he says that is really pulled back.
Mm-hmm.
Yeah, and one thing on land, since I know we really haven't addressed that question a lot yet on the live stream, let me say this. So the thing that you remember about land is you always want to purchase, if we're talking in this context, kind of where the city's actually growing. But what you need to know about land is you have taxes on land. And so you're going to have cost on raw land that's not producing income. So, for example, you can buy farmland, and if you can get what we call a 3 to 4% annual return off the crops, off that based on your investment, the amount you paid for it, and you can get a 3 to 4 to 5% annual return, that's probably pretty good for farmland right now. And by the way, for some of you that are in farmland, if it's not, would you make sure you send me that on chat and tell me what kind of return you're getting. The other thing, that's the reason you see these little storage building type things that go on land. People, the whole business model there is they go buy land that is well located. Maybe it hadn't been completely zoned and platted yet, which I'll talk about in a second. Mm-hmm. And they put that on there so it's generating income so they can pay their taxes and maybe make some income waiting for that ground to really be made to make good money in the sale. But the other thing is that that is important to know with land, and this is the kicker, and I've actually done okay with this. Is you buy a piece of vacant ground, and then typically those kind of, if you're out in rural areas, they have what's called an A1 zoning. Depending on what state or municipality you're in, they'll have like an A1 zoning, which is basically agriculture. It's used for agriculture. You can go in and have that ground rezoned, and you can have that, basically do it's called a plan development on that particular property and upgrade the zoning on that property. And then you can also go in and do a plat. And if you do a zone, an up zone, and a replat that gets approved, then sometimes, I'm not kidding, sometimes on ground you can make 10 times if you're able to go through that, and sometimes more, just on raw ground. But just remember this: raw ground by itself does not produce income. So you have to make a return on the appreciation of it in order to make any money, unless you put some kind of income producing business on top of that ground for in a temporary way.
That's awesome. Billy, thank you so much. This is coming in from Randy Francis. It's a great question. What do you recommend for commercial purposes? He says our nonprofit put down earnest money towards purchasing a $1.5 million property. Do you recommend we hold off for now? Our lender has slowed the process and is limiting loans.
Well, I would say, Randy, first of all, that's a great question right now. And we haven't really addressed it as much as we probably should have on here. But I will tell you this: there are some heavy hitters in the stock market that are shorting REITs, real estate investment trusts. They call them mall REITs. They're actually shorting the mall REITs that have this commercial property right now, because they don't know what's going to happen with the tenants. So I would say, if there's any area in the real estate market, there's others, but if I was going to look at a primary area in the market that we know with almost, not quite 100%, but we know with 90% certainty it's going to soften. Prices are going to get softer because some of the commercial tenants are not going to be able to stay in there, and the landlords will, I hate to say this, and I don't want to sound negative, but they're going to have to actually drop prices. So what I would say, Randy, is that don't get discouraged about that, because the very property you're looking at, it's very possible that price on that could drop. And in some cases, actually the bank that's holding the mortgage on it will actually, I probably shouldn't say this on a live stream, but they sometimes will actually force the sale of a property at a discounted level, believe me, just to get their money out of it.
That's great. There's a little more information that he just added, and he just said that they extended the closing 30 days already and lost $5,000 of the earnest money. And so I'd
have to know a little more about what kind of building it was and where it was sitting, who owns the building, what kind of loan is on it now, if there are any other kind of liens, that kind of stuff to know. Because always remember this: even in buying commercial property, which commercial properties typically always, the majority of the time is always a price based on income. My guess is this building you're looking at, $1.5 million, probably is empty. And so what they do then is they go to what we call replacement value. How much would it cost to replace this building if it was built new? And then you depreciate it if it's 10 years old or 20 years old against what that number would be. And so the truth of the matter is, my guess is it's empty. Now, if there's already tenants in that building and they're paying well, then that's another discussion.
Okay, great. Thank you. This is coming in from Margaret Petty, and she says, hello, I remember you saying that you got started by taking either a HELOC, a home equity line of credit, or a first mortgage so that you could get a 2.99 on a 30-year mortgage. And she said in that where they would be able to pull the cash out for a down payment to be able to purchase their first investment real estate. How would you do it? And would you do it now and just wait and sit on it to be able to purchase the property in the fall because you could get a really strong interest rate.
Yeah. So what you do is right now you start getting all the facts and gathering the numbers and talking to lenders. Doesn't mean you do it, but you go and you talk and find out what you need to know to get qualified. Let's say, for example, to do a HELOC. And you may know what was the name of the person asking the question?
Margaret.
Margaret. So Margaret, you may know already what that loan would be, but you may not know exactly what some of the terms are. Sometimes you can shop and, one place offers you one deal, another place offers you another deal. So you could do that kind of homework right now, but then I would definitely wait till the fall and really do an evaluation at that time before you jumped in.
Okay, that's awesome. Along those same lines, David Lee, who you also know, Billy and Becky, is on. And he says, hi, Karen. Hi, Billy. Hi, Becky. Real estate loans and lines of credit are drying up. What is your short-term and long-term views on this?
Okay, that's a question.
But,
So y'all ready for this? That's the reason the banks and the lenders are recognizing that the economy and the stock market are not meshing. So it's not a true representative. So what's happening, if you want to look at bond yields right now I'm on point, I'm answering your question. If you want to look at bond yields right now and compare them, bond yields are telling us almost without exception that the outlook for the market itself, the stock market, is not good. Now, the banks know that, and they're looking at the return. So what they're doing is they're drying up. There's two reasons they're drying it up. They're drying it up. One is because of where yields are, but secondly, they don't know. They don't know how all these assets out here they may be lending on are going to respond to the current economic environment we find ourselves in. So here's the next one. Because of the stimulus money that's in the market and these low interest rates that are out there, they're raising the qualifications on the loans to try to kind of stop the influx of capital or money into the market. And so right now, I just, because I know David and I know about his portfolio and those things. So what I would do, my advice to you in your specific situation is just be patient, because one of the ways that we'll know the economy's back, remember now, the reason that interest rates go so low is because how the economy is acting. You have to have money in the economy in order to stimulate it.
Right.
So rates have been dropped to make it easier for people to borrow. Now, hold on, I'm on point here. I'm on point. But what has happened is we've had something else happen. Yeah. The Fed has now stepped in and started flooding the markets with capital. So because of that, the banks have started backing up. And so restrictions have got a lot higher because, listen, if you get too much money into the economy, cheap money, it will drive the prices of assets too high, including real estate. And so they're trying to balance it out. That's why you're running into the problems you're having.
That's great, Billy. Thank you. This is an interesting question. It's coming in from Laurent Branez. And Laurent says this, first of all, hi, Billy and Becky. What do you think about package deal or trade deal to generate cash flow, and what are the risks involved?
I'm not sure I understand that question.
So package deal or trade deal is just a type of investment. Mm-hmm. I had not heard about it, but he's looking for ways to generate cash flow and wondering if this is a way to do that with this type of investment.
Yeah, so I have to answer. That's probably one of the first questions I've had on here, that I don't really know exactly what they're referring to, even though it might be common in certain sectors. But I'm not sure in what context even the question's being asked.
Okay, great. Yeah, so that might be something we can take a look at a little bit more and try to answer on Wednesday, the Facebook Live. I know it's a group of assets. There's like a timing involved with it, but we'll dig into that, Laurent. Thanks for the question. Okay, so we've got a question from chat that says, what types of homes would you be looking to pick up during this time? Is there a size, is there a type, or an area that provides the best opportunity in your view?
Middle class neighborhoods, not upper middle class, huh?
3-2.
Yeah, and 3 bedrooms, 2 baths, middle class, what we call bread and butter housing. 3 bedroom, 2 bath, brick homes in really solid neighborhoods. Now you're going to get a little less on the rent return on those, but what you do get on those is the appreciation typically long term. Now there are some local markets where you're not going to get that appreciation, so you really have to look for rent. But I would look for that middle class to lower middle class type property in that 3 bedroom, 2 bath, well located, stay out of crime areas, stay out of drug areas. And then for some of you that are in some of these hot areas, you have to go, remember, as we've been telling you on these live streams, you got to go away from and get out around in these smaller towns around some of these larger metro areas, or even if it's a town of 100,000, sometimes you may look a little bit outside of it if you want to find a little better pricing, but make sure it's kind of growing that way if you're going to do that.
What about starter homes?
Well, starter homes, and because we built a bunch of starter homes from scratch. I didn't physically build them. I invested in own the company, but we built a bunch of starter homes, and those not only did they appreciate well, which we both found out, they appreciated well, but the rent return based on our costs. But back when we did that in 2004, 5, 6, back in that time, we were building those starter homes I know these were brick homes, 3 bedroom, bath and a half.
Location.
And some of them had 2 baths. They were in good location. And we built those for $68 a foot, and we sold them for $100 a foot.
Wow.
Well, we also rented some too.
And then we rented, and we started going up the scale, and we definitely hit a price level that where it slowed down. But right now, the starter home, and honey, you're right. The starter homes in a lot of metro areas are absolutely that little 3 bedroom. If you're up here in Colorado, that little 3 bedroom, bath and a half house with some kind of basement. Where you can add a bedroom here or do something that you can really add value. Those kind of properties are most of the time, if you know what you're doing, they're a no-lose proposition.
Wow, that's awesome. And if I could just ask a question, with that, did you tend to find an area or a neighborhood, and then you just started going in and kind of like buying multiple homes in that same neighborhood? Or, how did you choose where you went in with those homes, and should they be close together?
Well, what we did was, I mentioned 04, 05, 06, but then when the crisis hit, we went in and actually purchased infield lots that were already developed. So they already had city
builders,
and we picked them up from builders. And there's a whole group of lots we bought. I know people are going to think I'm lying when I say this number, but I'm going to say it. We bought a whole group of lots for $2,000 a lot. And that was one of the ways we were able to build where builders pulled out. And of course, then they went into foreclosure. The whole thing got tied up. And so then it goes all the way back. And in this one case, it went back to the original owner, not the bank. And so we went back to the original owner and we just wrote them a check. And, they wanted to cash out, and we went in there. You already had, in most instances, you already had city streets. You had water, sewer, gas, all your stuff was there. And so that's one reason we could build at $68 a foot. And so we did that, and we made a ton of money doing that. And so that's just the blessings of God. But the truth is, you look for opportunity. And right now we don't know. Look, as we're recording these live streams, nobody knows where the economy is going to land exactly. But I believe there's going to be some opportunity coming, as we move forward into 2021.
Awesome. Here's a question too regarding IRAs. In the CARE Act, I was talking to Bill Bronchick, I guess yesterday, and there's a provision that people can withdraw $100,000 without penalty, without claiming income from their IRA. and they can use that money basically for 3 years and then return it back into their IRA. Is this a vehicle that people could be looking at to start to get into the real estate or investment market?
Yes, it could be. And the truth is you can pull out that amount of money. I think one of the things, at least the people we've had conversations with, are not as clear on as they should be. You have to pay that money back, and you have to pay that money back within that 3-year period. Or if you don't, you're going to end up, this is something most people don't know. I mean, they don't realize, even who have IRAs, even when you get to the age, whatever age, and they've also extended it now to 72 instead of 70 and a half. So they've given you another year and a half before you have to do what's called required mandatory distributions. But the truth of the matter is that when you start pulling money out of an IRA, always remember this: you're paying earned income tax on that money. If you pull the money out early, you're paying full earned income tax, which for many people would be in that 30% bracket. Not everybody, but many it would be. And you're going to pay a 20% penalty on top of that. So you're taking half the money that you've taken out and you just paid it in taxes. So if somebody's going to take the $100,000 for 3 years, that's great. I think it's awesome, but you got to know what you're doing, because you're going to have to pay that back. Because if you don't, you're going to pay whatever taxes you haven't put back in there. You're going to pay it on that amount, plus a penalty if you don't pay it back.
Oh, that's very helpful. Okay, that's great. And these are the types of things, maybe we could take a moment to Mike, Billy, and Becky and just talk about, these are the types of things that we're going to be covering in the real estate workshop. Mm-hmm. We've got a lot of detailed questions, and we have some Q&A in there as well. And we can touch on things on this live stream, but we go in deep in all these opportunities at the real estate workshop. And Mike, I see that you just turned your microphone so that you could speak. So go ahead.
I was just going to suggest that there's also a self-directed IRA that you can get at a corporation like Kentucky Trust and other ones, where you can use your IRA money to actually purchase real estate. And I know, I think even Bill Bronchek sets that up as well. If you wanted to mention something about that, Billy.
Yeah, Bill's got a great, teaching, but it's not just a teaching. He's got a great system on how you can.
He's going to be on our live stream.
Yeah, and Bill will be on our live stream, and he'll be teaching on that as well. Mm-hmm. So on the live stream, he'll teach on that, and Bill's he's a pretty well-known real estate guy out there, even in the secular world, as far as teaching and training. I call him my Jewish lawyer.
He's our Jewish lawyer.
He's our Jewish lawyer. So, but I think with that, so that you can do that, and what Bill teaches, which is correct, you actually set up an entity. We would call it an LLC. You can invest with your IRA into that LLC. Now, there's certain requirements, certain rules you have to follow, but Bill has all that worked out, and so it's a great way to use your IRA.
Awesome. Thank you. Okay, we have time for really one more question, and this is switching gears a little bit from real estate, but something that you mentioned earlier about people not going back to work. So the question is, if people choose not to go back to work, it seems like the unemployment check should stop. Is there a process in place with the CARE Act that is going to watch that so that businesses are not continuing to have to pay unemployment when people choose not to go back to work?
Yes, there is. And there's, if you read the CARE Act, there's certain time frames. Mm-hmm. The other thing, if I can just make a quick comment, that on the PPP, which I know that's not what they're asking about how long the unemployment would go. There is a time frame, but what people need to know, even on the PPE, if you took money in the PPE, your application process to be forgiven for that is much more extensive than actually getting the money. It was much easier if you were able to verify that you had paid these salaries or whatever during this. I think it was from February the 15th or whatever. If you're able to verify that, then basically they loaned you the money. But in order to get the forgiveness for that money, it's a very involved process. So, well, let me just say this, it's much more involved than the other side. So those that have PPP loans need to know that, and make sure you're talking to your bankers and getting the direction and the guidelines that you need.
But I think there are still some guidelines for unemployment too, on both sides.
Absolutely. All right. Well, thank you, Karen. And Thanks to Mike and Karen for helping us today. And of course, I just want to say thank you to all of our office staff. We have 3 girls behind the scenes, one here. So we have Gabriella, Celine, and Miriam that are in Denver. We have Rebecca that's here in Woodland Park, and we have Derek that's in Colorado Springs, the whole team.
Karen in Texas.
And of course, Karen, but we got Karen and Mike. And so we appreciate the whole team that helps put these on. But today, before we go, honey, we want to pray.
Absolutely.
And pray for people. And so right now, just let Becky and I pray for you, speak increase and blessing over your life. So Father, right now.
I think we need to put peace in there because there's so much uncertainty of what's going to be happening that we really need to have the peace of God.
Amen. Well, the Bible gives us the promise about the peace of God where it says in Philippians chapter 4, verse 6, be anxious for nothing, but in everything with prayer and supplication, let your requests be made known unto God. And the peace of God, which passes all understanding, the Bible says, shall garrison about your heart and your mind. And so we speak that and pray that over you. So Father, right now, Becky and I pray today for those that are participating with us here in this live stream. We pray for increase and blessing over their life. And today we declare and speak the peace of God over them today in their lives and their minds. We thank you, Father, that you garrison about their hearts and their minds in Christ Jesus. And we thank you for that today in Jesus' name. Amen.
Amen.
God bless you. We'll see you right back here on another live stream. Bye-bye.
Bye.